from being in this field, there were times when the CPI used for this calculation was only like 1.3, 1.7. So while the newer owner, albeit 10 years or as of today, has not had that protection, you're going to see not a difference in the market value. The market values are going to be the same, but you're going to see a vast difference in the assessed value and the taxable value used to determine taxes to be paid.
All right. To put everybody in the audience on notice here, what we're referring to, there are a variety of exemptions. So again, your job, Dana Blickley, the Brevard County property appraiser, is to assess the value, the market value of the property, and then you can apply exemptions as well. And there are several or many different exemptions available, but the most common and the most significant is the homestead exemption. And the homestead, can you tell us a little about defining the homestead exemption?
Sure. So a homestead exemption can be applied for and approved on any property in the state of Florida where a taxpayer claims or a resident claims that's their primary residence. So it is by law defined as a residency-based exemption. You can only have one. So if you can own as many properties as you'd like, but you can only have one residency-based exemption. And that includes properties that you own outside of the state of Florida. So if you own, say, another home in New York and you have had the residency-based exemption known as a STAR exemption in New York and you move to Florida and you want to claim Florida as your permanent residence, then you have to surrender your exemptions there because you can only have one. Very, very important for all of your listeners to know that. It comes with a very severe penalty whenever we find that's the case. And the law gives us no discretion to pick and choose who we want to lien. So if that happens to happen, I am required to apply 50% one time and 15% per year penalty up to 10 years.
Right. So I do want to come back to that because we have had issues.
I've had
clients with that unfortunate circumstance. But with regard to the homestead exemption, so the exemption is initially, if it's your principal primary residence, is how I always define it.
Correct.
If it's your principal primary residence, you get $25,000 off the assessed value, becomes part of the taxable value. And then there's a second up to $25,000 additional exemption, which has some requirements. I believe the primary one being the house is assessed at least $75,000.
You are such a good student. No. See, my job is done right there.
Okay.
You're correct. That can be confusing for folks because folks don't quite understand that in order to benefit from the full $50,000, you have to have at least $75,000 of assessed value. If not, you only receive a portion of the second $25,000. We do have a pictorial, like a pyramid type of image that we put both in the trim notice excerpts when we send out the notice of proposed property taxes that kind of helps folks explain that a little bit. So yes, you're correct. In addition to homestead exemption, there's a myriad of what we call personal exemptions that folks can apply for. They range from widower exemption, disabilities for blind, civilian disabilities, total and permanent disability exemptions. We have limited income senior exemptions, reductions for grandparents' quarters. There is a multitude, I am very, very proud to say, for the state of Florida for our veterans that are disability exemptions for veterans. There's a myriad of those depending on the percentage of disability for our veterans.
Right. That, again, it's excellent information on the website. That's where I educated myself.
Yes.
The other thing that comes into play, which is playing off of what you said, Jean, and what I see all the time, I believe it was 1994, but they passed the Save Our Homestead Act or constitutional amendment or whatever it was, the law that the intention was when the market values were going up so rapidly, people who were living in their homes, their tax bill kept going up, in accordance with the increase in property values. And so the state of Florida, the citizens decided to pass this Save Our Homestead Amendment so that property value the tax amount could not increase. Is it the actual tax amount or is it the assessed amount?
It's the assessed amount. So that is Amendment 10 to our Florida Constitution, and you're pretty correct on your dates. We voted on that in 1992 and passed that in 1992, and it became effective for the 1994 tax year. Okay. So yes, that is when the assessment cap related to Save Our Homes or Amendment 10 came into play for Florida taxpayers.
Okay, so what that means is, I'll use round numbers. Your house is, the market value is $100,000, and in the year you get assessed at $100,000. And then you have your $25,000 exemption, let's call it, and so your tax value will be based on with the exemptions. But then a few years later, the market value has gone up and up and up. There is this cap, which is defined as the lesser of 3% or the consumer price index.
Correct.
Okay. And then the assessed value then cannot go up more than this cap. Let's call it 3% for now. So your market value may end up being $200,000, but over the course of 3 years, your assessed value is only $109,000 because it went up, or my math may be wrong, but yep. Close enough.
You're doing good.
Then that would account for why neighbors may have very different tax bases, because one person has owned it and had this cap in effect, and the other person just bought it for $200,000. Their cap will start when they bought it, but they're going to be assessed at $200,000.
That's absolutely correct. And Jonathan, let me expand on that. So in response to that amendment, we had Amendment 1. Which came behind that in 2008 because Amendment 10 kind of changed, not kind of, but created a shift in the tax burden primarily from residential to non-residential or non-homesteaded properties. So in response to that, another amendment was passed, and we now have assessment caps for non-homesteaded properties that is at 10%. So for anything that's not a homesteaded property, if it does not change owners, receives the benefit of a 10% cap.
And that's 10% of the assessed value.
That's 10% of the assessed value, meaning that year one, say the year that you purchased the property, say it's a new commercial property or a new residential that's not a homesteaded property, for $100,000, we're going to say the market value is $100,000 and the assessed value is $100,000. The next year, if the market goes up 12%, the actual assessed value is going to be capped at 10% for that property.
All right, that's excellent. And I do recall that from 2008, but
yes.
It's good to know. And that applies to all non-resident. I mean, does it apply to an investor who has an investment condo?
That it applies to all property that's non-homesteaded.
All non-homestead property. That's great news. Then one of the other things that I noticed on the website that was very interesting is we have some people who have owned the property for an extended period of time. So this assessed cap has kicked in. Well, now properties are starting to go down, and they're expecting their taxes are going to go down because the property values are going down. But in fact, sometimes that's not the case. And as I understand from the website, that could be because the assessed value has not caught up with the market value.
That's correct. That's correct. You won't see that particular scenario very much right now because we've been experiencing for the past 3 years appreciation in just about every area of the county. Some much higher than others. Our beachside communities, District 4, Suntree Riviera area, I have to tell you guys, is a hot area. So we're experiencing a little bit more than 10 or 12% of those areas. But even in the aggregate from last year to this year, I was looking at some statistics before I came today, and we had an increase in our taxable value in the aggregate from last year to this one of 8%. So, yes, you're correct. If we were to make a change or we were to reduce the market value, but it was not less than the assessed, the net result in taxes would be zero.
Okay. Then coming back to the homestead fraud, which again on your website, it says, please report fraud. And it is very important. I've had clients who have been in an unfortunate situation because they've inherited a property. So the mom, let's say, had the property and she passed away and it had been her homestead, but they never went through the probate process, and for whatever reason, the property appraiser just continued to assess it in the estate of mom, and it actually had passed, though, to the children who were living in the property but never declared it to be their homestead. And then sometime later, they got hit with the reversal of the homestead exemption. Is there any advice you can give to prevent unfortunate scenarios such as that?
I do. And I talk about this in just about every opportunity that I get. We do a lot of community outreach, and I attend venues like this, radio shows, to talk about this. So you basically have two classifications of homestead fraud. You have intentional fraud, where folks know better and they're going to take the chance. And unfortunately, if we do catch them, and many of them that we do, then they're going to experience the penalty for that. We're going to remove the homestead exemption, and also they're going to start over. So that's quite a penalty. And again, that is statutorily driven as no discretion from any property appraiser. It's a shall, not a may. But the other, and I'm very passionate about this, is the unintended homestead fraud, where, let me give you an example, and we see this over and over again. So a couple up in years, a senior couple, had a property or has had a property in their family for years and years in another state, and they have a residency-based exemption that doesn't sound or look like homestead exemption. Maybe it's called a circuit breaker, and it's a $8 tax benefit to them that they've been receiving for 35 years. Fast forward, they moved to Florida, and they've been living here for 20 years. One of them, unfortunately, passed away. Homestead exemption's intact, and then we receive some type of temporary address change or something that sparks us to take a look at that, and we find that they have another residency-based exemption in another state. I have tried, and it's a legislative initiative for me. Didn't quite get it passed last year, as you know, everything. There's no tax package that made it through last year. But I believe there needs to be a remedy for those bona fide Florida residents that did not realize they had this benefit, where they could, in a sense, pay the jurisdiction whatever the benefit received was, so they could retain their benefits here and not be penalized. And I can tell you I'm going to continue that initiative until I'm successful or they throw me out.
All right, well, that sounds great, and I will do my best to support that.
To try to prevent our folks from experiencing that in Brevard, we do many things in the process when you're filing for a homestead exemption, to the point where it might even feel like an inquisition when you come to file. But we're going to ask you through that application process, are you receiving benefits anywhere else? We're going to go one step further and ask you, do you own property in any other state? And if you answer yes, we are going to require you to get a letter from that jurisdiction stating that you have no residency-based exemption benefit. And that is simply to protect us from us.
Right. Well, that's excellent. Again, I wasn't aware of that. One of the things that, as a real estate attorney, I do all the time are quitclaim deeds for estate planning type purposes. So we have mom and dad, and it's their homestead, and it's going to continue to be their homestead. But again, after consultation, we make the decision to add son to title to the property with a right of survivorship, et cetera. And I always advise clients, but I'd like to confirm I'm doing right now, always advise clients that whenever you record a deed for whatever purpose that you're recording it, even if it's, say, two single people who then get married and record a deed to create a tenants by the entireties. Anytime you record a deed, as I understand it, it resets the exemptions, at least with regard to whether they're there, and you need to reapply to make sure you maintain whatever exemptions you may have had prior to that deed.
Jonathan, that is great advice, and that is the right advice for any person or even members of our legal community that are working in real estate transactions. In most instances, any time a title changes, it requires someone to make a new application for homestead exemption. It may not be the type of change that affects the benefits that they're receiving or affects their cap, but it does require that they file based on the title as it is now. So we tell everyone to be on the safe side, contact us and find out if we need a new application. Now, generally, you will hear from us whenever you record something if we need a new application from you. But there's 350,000 of you guys and one of us, so that's great advice for your clients, and we appreciate that.
Well, I appreciate the confirmation. Go ahead.
Well, the minute that we have left, could you define the word primary resident? What do they need to know to qualify as a primary resident?
Sure. So typically your primary residence is the number one, the one that you designate as your primary residence, and you typically do that through documentation that you establish through personal information, such as where you register your vehicles, where you're registered to vote, the address that's listed on your IRS tax return and on your driver's license. So basically your residency documentation typically will dictate where your primary residence is. So it doesn't mean that you have to spend the night 180 days at that residence. It just means that you cannot claim any other property as your primary residence and receive a benefit on another.
Well, we really appreciate you being here with us. And Jonathan, I want to thank you. And Jonathan?
Well, I want to thank you, Dana Blickley, the Brevard County Property Appraiser. It's been great information. I appreciate some of the confirmations of things we've been doing, but also the new information that's available. I do recommend everyone visit the website of BCPAO, as in Brevard County Property Appraiser's Office, .us, bcpao.us, for more information.
Great. And again, we've been speaking with Jonathan Lack, my co-host, who is at Lack & Lack Chartered, real estate attorneys at law. And for more information on the guests we had today or our previous guests, you can go to yourhometownsolutions.com. This is Jean Newell thanking you for tuning in today for Your Hometown Solutions.